Hello and welcome to Investing Confidential. Big question now today everyone's talking about is the midterms, the rally. Will there be a rally? How long is the rally going to last? Let me answer some of these questions and then we'll go into what's really important right now is the economy. But okay, let's talk about rallies. Whatever the reason for these rallies, the big question is this a new bull market or is this just a bear market rally? I am betting, as I have been saying all along, these are bear market rallies. Look at the history of bear market rallies here, okay? In all of the big bear markets, and by the way, we haven't seen a big bear market in quite some time, but in the big bear markets, we have seen these rallies. They're vicious rallies. We've said that from day one. Bear market rallies are more vicious than bull market rallies, okay? And as you can see here historically, they're very common, but they're fadeable. You have to fade them. So we have tomorrow the midterms. Obviously, they're incredibly important for the U.S. and for politics, etc. But from an investment standpoint, if the polls are correct, and I have no idea about polls, but if the polls are correct and the Republicans take the House and the Senate, we're going to have gridlock. Okay, gridlock. I mean, the White House, the Biden administration is finished, essentially from a standpoint of making policy. He will be blocked at every stage. Everything that they try to do, they will be sued by federal judges. So this is what they call classic gridlock. Gridlock historically has been very good for the stock market. So I wouldn't be surprised if there is a rally coming because of the midterms. Morgan Stanley saying, to buy stocks. Again, you got to discount what these brokers say. In fact, because of this, I may fade. I would probably fade this rally, but in the short term. But regardless to say, they're hopping on the bandwagon. The street is always bullish. Okay, they're never bearish. They're always bullish. They're bullish when you lose 20%. They're bullish, when you're up 20%. It doesn't matter. So disregard all these Wall Street firms. But Morgan Stanley is obviously pushing the bull case for the midterms. But one thing you got to understand here, folks, is we are still why these bear markets rallies are so vicious, because you have positioning that gets so bearish, and the problem is that in the short, what's happening today, for example, and here's a perfect example of this article about, and I've been saying this all along, people buying put funds instead of buying puts on stocks or indexes, they're buying put funds. What that means is they're buying ETFs or funds that are buying puts for them. I mean, this is not good. These Wall Street firms put together these funds to make money, purely to make money. They don't care if the market goes up or down. In fact, they want the market to go up, and they want you to lose money, believe it or not, because they want to cover all the fees they're taking. Never ever buy a put fund. If you're going to buy puts on the S&P, buy puts on the Qs, buy puts on Apple, whatever it is, but don't buy these put funds. They're a license deal by the brokers, and I would never touch them. The same with all these levered funds that they push. Just stay away from the folks. They're just a complete waste of time. The other big news coming this week is the CPI. Okay, I've been saying all along, inflation has peaked, but is very sticky. So if we see an inflation print on Thursday that is, let's say, below 8%, the stock market is going to roar. Gold is going to roar. Emerging markets are going to continue in the rally. Bonds are going to turn around. And people are going to start talking about a pivot again. Okay? Listen, this is the day after or the moment after the CPI begins to show signs that inflation is down. You're going to hear this word pivot. There's going to be no pivot, folks. I said that from the beginning. The Fed's going to have to see a lot more decreases in the CPI for them to signal a pivot. So again, don't believe the pivot. It's not going to happen, but certainly inflation has peaked. But what does that really mean? Inflation has peaked. The Fed's they continue to raise rates. It's going up. That means the economy. Okay, since we're in election times, I'm going to say something. It's all about the economy. Stupid. Okay, that's the expression, right? For politics, it's about the economy. Stupid, and the decrease in CPI. Okay, is kind of artificial because obviously the administration is doing everything they can to change CPI indexes. But what it really focuses on is that the economy is very weak. And because the economy is very weak, demand is dropping like a stone. And this is why we're going to see decreases in the CPI in the next few quarters and maybe over the next year. But it's not going to decrease as much as you think. We have gone through a $6 trillion of money printing. There is no chance, zero chance, that inflation is going to go down to the 2% level. We have very sticky monetary inflation. I'll go into that in some video in the future. But so that's why these things are temporary. These are bear market rallies, okay? Some signs of the economy. I'm going to show you a bunch of signs. First here, we talked about layoffs. Everyone's talked about the layoffs that the tech companies announced last week. Look at here. Global law firms, big law firms. Now, the law profession has normally been, recession-proof, right? Hey, everyone needs a lawyer to do anything. You need a lawyer just to sneeze sometimes. But these law firms are laying off. Business is down. Corporate business is down substantially. This is a bad sign for the economy, global law firms laying off people. The other thing in terms of the economy is just follow the trend here. Here's a chart on deposits. I think I've showed this chart before. Deposits in banks are plummeting. People are draining their deposits, and now they're at the bottom. They're at the end. So they've been living off this is why the job numbers are all fake. People have been living on their deposits. They got all this money from some COVID relief, whatever, unemployment. They've drawn this down, and now are they going to go back to work? Maybe. But one thing's for certain is consumer spending is dropping off a cliff. Okay, dropping off a cliff. And again, the US is a consumer economy. It's not a manufacturing economy. It's not even a tech economy. It's a consumer-driven economy. End of story. So when consumer spending stops, the US economy drops off a cliff. And that's what's happening. Look at another indicator. This is a high yield spread versus investment grade. It was ridiculously tight during the artificial lowering of interest rates by the Fed. Now they're normalizing rates. High yield is blowing out. What's that telling you? We're going to have serious issues in the business world. We're going to have companies going out of business. And what does that mean? More people laid off, more consumer problems. So, watch high yield spreads, watch junk bonds. Okay. As junk bonds start to widen, it's very bad for the economy. These are red warning signs. You cannot disregard these signs. Okay. Look at Wall Street. Wall Street's in trouble, folks. Wall Street's in trouble. There's no deals for these people. Okay, Wall Street has been in a secular decline. Okay, secular decline for quite some time. Technology and competition has from alternative lenders and other things have really beaten down the margins of Wall Street. Now you've got no IPOs, no bond deals, M&A's down. These banks are in trouble. And what happens when banks are in trouble? They are classic. They lay off tons of people. We talked about this a few weeks ago. Goldman Sachs, Morgan Stanley, they're all laying off people. Rolling off people. Not good for New York City, but that's another story. But this is not good for the economy as Wall Street retrenches and lays off tons of people. And this, again, this is a global perspective, okay? Central banks, as I'll show the chart again, central banks around the world are tightening. They're all tightening. The if our CPI drops, if inflation goes down a little bit, it's not going down in Europe anytime soon. So the entire world, with the exception of a few countries, are still tightening. Okay, and that's a bad sign for any company, large cap company that exports, etc. So again, more signs that things are bad. Okay, let me talk about these job numbers because I mentioned it. Look, folks, these job numbers I told you before, not that they're fake news, but the data is old. The way they gather the data is old. It doesn't make any sense. I mean, it's bad data. They look at ads in Indeed and all these sites. I mean, this is just malarkey. They're not talking to companies. The problem with all these type of data they're getting, they rely on phones, like regular phones, which no one uses anymore. They rely on data that can be manipulated, like Indeed ads. They're not real. Okay, these job numbers are not real. I don't even, unless the government, overhauls them, they should just stop talking about that. But here's a real story. Here, look at these temporary workers. Okay, temporary workers are through the roof. There are a lot of people. You may be one of them that's listening to this video that have a couple of jobs. They have a temporary job. They have a gig job. They're doing contract work. Okay, and you're making a living. You're paying your bills, whatever. You're not considered unemployed. You're not considered part of the economy. Okay, so temporary workers, even though if they found a really good job, a good paying job, they take it, because there aren't good paying jobs out there, believe it or not, folks. That's why everyone's doing gig work and doing temporary, doing 2 or 3 jobs. The economy is not good. Okay, despite all these numbers you're seeing, the economy is not good. And then you have Morgan Stanley again. I hate picking on them, but they're saying tech layoffs are good for stocks. I mean, you got to be kidding me. This is the industry that has been hiring more people over the last 15 years in any industry that we have. And you're telling me that layoffs are good for stocks? I'm sorry, they're not. This is, again, leads to what I'm saying: consumer retrenching, consumer economy falling off a cliff. Again, another sign: Carvana, one of these big hype technologies, going to change the world. Cars are sold, whatever. It could in the future. This could be the future. But for now, the problem with Carvana is they raised so much money. They had to make money. They had to show something. So what they did was they became a alternative lender. Started lending to people that don't have very good credit, and now they're suffering the case because the consumer's not paying. They're not getting paid. Used car prices are dropping like a stone. They were buying a bunch of cars. They have a bunch of cars on inventory, and prices all of a sudden have spiked down. Again, Carvana to watch. That means obviously is a leading indicator for inflation, because people look at used car prices. The same thing is going to happen in the real estate market. We had a big bubble. Again, watch Open Door. Watch all these companies that have been playing the game on the real estate market, holding a lot of inventory. These companies are all out of business, like Carvana. Another sign we've got issues here in the U.S. Well, let me switch a little bit to the global markets, because that's where I think the real action is happening. The U.S. dollar rally, which is really, as I mentioned in previous videos, has really hurt the asset prices around the world. Could be over, could be stagnant for a while. And that's going to affect a lot of things. First, we'll talk about gold. Gold prices have been hit very hard. Like I talked about, I got rid of my gold positions. I started buying back. I said it ranged between 14 and 1500. We got down to the 1500 range. Then all of a sudden, we saw a lot of buying in gold. I didn't understand. Gold should have fell a lot more than it had. Should have had a flush. But central banks, as you can see here, central banks have been buying gold. Okay, they've been buying a lot of gold, and they've been cushioning the price. And why are they buying gold? Well, they see disaster. Okay, they know they could see the economy. The economies around the world are falling off a cliff. They see that. They see fiat currencies. They see all of this. And they're buying gold because gold has been around for 3,000 years. So that gives me a little more confidence that gold maybe have done a short-term bottom. I'm not going to buy a whole position back, but certainly gold is something very, very interesting, along with emerging markets which benefit from a weaker dollar. China, a lot of stories here about the Chinese COVID policy. Should we be buying stocks on back of this? Is China going to get away? Look, there's no chance that China is going to publicly get rid of the zero COVID policy. They're deep in it. There's no chance of going back. They may relieve some restrictions on foreigners coming in, but man, they are not going back. They are still testing tons of people. As I mentioned before, they have the ability to test 1 billion people. It's very expensive, so certainly they're going to pull back on some of that. But if you go to China and you happen to have COVID, or someone you know has COVID, you're going to be locked down for a very long period of time. Very long, and the Chinese people know that, and they're very worried. So what does that do? That they pull back. Consumer pulling back in China. Again, another negative for the global economy. Now, positive, okay, something positive finally. I always try to talk about something positive on these videos. Look at Turkey here. Now, I put Turkey here because it's something that actually everyone out here can buy, the Turkish ETF. There are a bunch of Turkish stocks that are listed in ADRs. You go to ADR.com, you can get a list of them. But it's a market no one's talking about. And this is one of the countries, along with Brazil, that decided to cut rates because they raised rate. They were way ahead of the US. Now, look, I don't have anything nice to say about Erdogan and the Turkish government. I think they're fascists, and they know they're fascists, and that's not something that people don't know. I'm not talking out of my head here, but they did some things interesting. They were ahead of the game because of bad policies they made. They raised a lot of rates. Now they're cutting rates. They're in a good position. They've benefited from this war. Obviously, they're trading partners with Russia. Russia's got a lot of cash. Russia needs to buy things. Turkish is one of the big suppliers. Turkey is one of the big suppliers. So again, you've had, while we were suffering through July, August, September with a 20% or whatever, the downward, the stock market there is up 50%. Okay, very interesting. Do you buy Turkey here? No, but it's certainly something you want to watch on a pullback. Two things. Last two things I want to talk about are they're market related, more longer term. This may be shorter term, but something that's very interesting. Here, what I'm showing here is capital calls. So capital calls are anytime you invest in a private equity fund, venture capital fund, any type of private lending fund, you commit to, let's say you want to put in $1 million, and obviously this is for people a lot of money. You commit to putting $1 million in, you put $250,000 down, and what they do is over time they give you capital calls. Well, imagine getting a capital call now when your stock investments are down and everything seems to be falling off. There's a lot of problems here in this market. Okay, this is going to hurt inflows into stock. These are people with a lot of money. These are pension funds, family offices that normally allocate money to stocks. They've been pulling out. They're going to have to. They are legally required to put this money in. Okay, they are legally required. So this is another worrisome part, also part of this whole idea of why I think we have bear market rallies. They can't sustain when all of these large funds have to go. And they, by the way, a lot of these guys over the last 2 years worrying about the stock market have allocated billions, maybe $1 trillion into VC funds, private equity funds, private lending funds. So this is a massive, massive asset allocation that has been done and now is certainly going to have some impact on flows into stocks and bonds. And the last thing is kind of sad here, that has more longer term impacts. But when you see something like this, a generation, young folks out there having very low expectations of having a better life than their parents. And this has started, a number of years ago. This is not a short-term thing, but let's say 2 or 3 years ago, this really began to slide, maybe 4 years ago. And this is sad, folks, because, when I grew up years ago and others over time, we always had this, hey, I'm going to do better than my parents. And my parents wanted me to do better than they did. And if you look at the generational gap going back to, let's say, in our modern times, to the, our great grandfathers in the early 1900s, etc. Every generation did better than their parents, did better than their grandparents. I mean, amazingly better overall. And their expectations, more important, their expectations were better. But we've seen a big shift, and I don't know why that is. I have a feeling a lot has to do with social media and the amount of information that's out there, because too much information sometimes is no good. But this is a very sad thing. And it does have ramifications for investing over time. And it's not good, right? But this is a longer term indicator. But again, I think over time, I'm an optimist, even though obviously I talk a little bit different game. I'll talk about markets. Better times are ahead for everyone. Have a longer term perspective. Invest instead of trade. So as always, for all you investors out there, first, please subscribe. But for all you investors out there, be careful out there.